These are the Simplify High Duration ETFs. Simplify Bond Bull ETF, ticker symbol RFIX, and Simplify Interest Rate Hedge ETF, ticker symbol PFIX. In this video, we'll discuss what are RFIX and PFIX, how the funds are managed, and portfolio use cases. First, what are RFIX and PFIX? RFIX and PFIX are high-duration products with returns based on movements in U.S. Treasury bond yields. An extended amount of duration among the highest duration products that can be found in the industry, and with a high degree of convexity. We'll talk more about this in a moment. Duration for RFIX is modeled at approximately 36 years at the time of this recording, while PFIX has a modeled duration of about -40 years. By comparison, the Bloomberg Aggregate Bond Index, which is the index that most bond portfolios are benchmarked to, has a duration of about 6. So RFIX and PFIX have about 6 to 7 times the duration of the benchmark index. Keep in mind that while the exact duration figures can move substantially as interest rates change, these figures can serve as a rough guideline for what investors can expect. Bond bulls, those who are expecting interest rates to decline and thus bond prices to rise, would find great utility in RFIX. While bond bears, those who are expecting rates to increase, thus bond prices to decrease, can express their view using PFIX. One of the key features of both funds is their high degree of positive convexity. Let's discuss what that means. For RFIX, if the underlying interest rate increases, for example, by 1%, the fund will have a loss. If rates move the exact same amount, but in the opposite direction, the fund will have a gain. However, for the identical movement in interest rates, the potential gain is greater than the potential loss. That is the definition of positive convexity. For PFIX, if the underlying interest rate increases by 1%, the fund will have a gain. If the underlying interest rate decreases by that same 1%, the fund will have a loss. But again, the potential gain for the same degree of interest rate change will be greater than the potential loss. Here's how RFIX and PFIX are managed. The funds buy instruments known as over-the-counter interest rate swaptions. These are functionally equivalent to buying call and put options on Treasury securities, except that the expiration date can be as long as 10 years. Compare this to similar options on bond futures, which usually expire within 6 months. It doesn't take a large cash outlay to get the desired exposure, so the bulk of the assets remain invested in short-term U.S. Treasury securities. Lastly, the options may be rolled into new options over time as they approach expiration or if there have been significant interest rate moves. Here are the characteristics of interest rate swaptions. They are not exchange-traded, meaning investors cannot buy these instruments through a typical brokerage account. They are obtained directly from major global banks. They require specialized agreements known as the International Swaps and Derivatives Association, or ISDA agreements. Individuals, financial advisors, and even most ETF sponsors do not have access to these instruments, which are typically only available to large, sophisticated institutions. RFIX's swaptions are functionally equivalent to owning 7 years to expiration call options on 10-year U.S. Treasuries. PFIX's swaptions are functionally equivalent to owning 7 years to expiration put options on 30-year U.S. Treasuries. The long time to expiration minimizes the option time decay, otherwise known as theta, which makes these funds viable as long-term buy and hold positions. investment professionals can easily model these swaptions on Bloomberg. There is little ongoing management. Adjustments are infrequent and mostly consists of adding or removing swaptions when the funds have inflows or outflows. The swaptions may be rolled into new swaptions as they get closer to the expiration date or if interest rates have changed significantly. It's entirely possible that aside from trading to handle inflows and outflows, the funds may not be modified for months or even years. Now let's review some use cases for RFIX and PFIX. The first obvious use case is to use these funds to express a particular market view on interest rates. RFIX would be chosen by investors tactically bullish on Treasury bonds, while PFIX would be chosen by investors tactically bearish on Treasury bonds. Positions would be sized according to how much positive or negative duration the investor wanted exposure to. The funds have multiple use cases as a potential hedge. Here are some examples. Suppose a real estate investor has a construction loan that will need to be converted to a mortgage upon completion of the project. They could own a position in PFIX as a hedge against the possibility of rates moving higher in the interim. Another use case for PFIX would be for investors with a significant bond portfolio who are concerned about the potential for rising interest rates but don't want to sell their portfolio and realize taxes. PFIX's negative duration would reduce their interest rate exposure without needing to sell any positions. Historically, Treasury bonds have performed well during recessionary or crisis periods, while equities have struggled. One use case for RFIX would be as a potential hedge against a recessionary period. Another use case would be for investors who have a long-term bearish view on bonds, but are concerned that rates may move lower in the near term. They could put on a small RFIX position as a hedge. RFIX and PFIX can be useful tools to fine-tune a portfolio's duration. Suppose an investor wanted to take advantage of the higher yields offered by newer issue, higher coupon mortgage-backed securities. They invest in a fund that invests in these securities, which has a duration of about 5. Meanwhile, a mortgage-backed securities index fund has a duration of about 6. The investor wants the higher yields of the higher coupon mortgage-backed securities fund, but doesn't want to give up the duration because they believe rates may decline. If the investor invested 97% of their mortgage-backed securities allocation into the higher coupon MBS fund, that would give them a net duration of about 5. Then they could invest 3% of the allocation into RFIX, giving a duration of about 1. Combined, the duration of these two funds would equal about 6, making them roughly duration neutral to the index. But the most important use of these funds is for capital efficiency purposes. Suppose an investor was positioned in a portfolio with 60% stocks and 40% bonds. The bonds were positioned very similarly to the Bloomberg Aggregate Bond Index. This benchmark has about 6 years of duration, multiplied by a 40% weighting equals an overall portfolio duration of about 2.4. Suppose instead the investor allocated 6% to RFIX. With a duration of about 36, a 6% allocation results in a portfolio duration of about 2.2, which is close to the same duration as having 40% allocated to the aggregate bond index. However, this frees up 34% of the investor's assets, which they can now use to invest in any asset of their choice. They can keep the assets in cash, invest in more stocks, invest in other assets like gold or crypto, or other alternatives such as commodities or managed futures. By using RFIX as a capital efficiency tool, other assets can be given an allocation without having to reduce the core stock or bond exposure. Another example of using these funds for capital efficiency is to combine 90% in a high-yield bond ETF with a duration of about 3 years with 10% in RFIX, giving a duration of 4 years. The two-fund combination has a duration of about 7, closely matching commonly used bond portfolio benchmarks, but with a significantly higher yield. Now for some Q&A. How do RFIX and PFIX differ from leveraged treasury funds? First, it's difficult to find funds with as much positive or negative duration as RFIX and PFIX. Furthermore, daily rebalanced leveraged funds are also subject to volatility drag, meaning their returns are often worse than what the leverage multiple would imply. Lastly, RFIX and PFIX have a large degree of positive convexity, meaning that for the same upside or downside move in rates, the potential gain is greater than the potential loss. This is a key feature of the funds. How much interest rate sensitivity do RFIX and PFIX have? They have roughly 6 to 7 times the interest rate sensitivity of a typical investment-grade bond fund. However, due to the fund's high durations, investors can make their portfolio duration neutral to commonly used benchmarks using only a small allocation. Given the efficiency of RFIX and PFIX, is there any reason to invest in a traditional bond fund? Yes. Investors looking for a particular bond market sector, for example, corporate bonds, mortgage-backed securities, or municipal bonds, will need to invest directly in bond funds covering those categories. Similarly, investors looking to target a specific point on the yield curve, for example, 2-year treasuries, will need to look at alternatives. What is the counterparty risk of the swaptions? The swaptions are secured by collateral held by the fund's custodian. In the unlikely event of a counterparty failure, the primary risk is being briefly out of the swaptions until the replacement positions can be initiated with a new counterparty. Thanks for watching this presentation. For more information about RFIX, PFIX, or any other Simplify ETF, please go to simplify.us/ETFs. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can get in touch with us directly and we'll respond promptly.